Hi, I'm Malcolm Graham-Wood, and today I'm starting a new series of CE interviews here at Core Finance. And my guest today is Andrew Austin.
Good to see you again,
Nice
Malcy.
to see you again, Andrew. You're chairman of Kistos, which has come to the market recently. We interviewed you very briefly during lockdown when you told us that things were on the move. And they really are, because you said at the time that you were hoping to announce a deal in Q1, complete it in Q2, and by the sounds of it, that you're on track for that.
We do try and do what it says on the tin, Malcolm.
To be fair, you always used to as well, so I can't grumble about that. Obviously, with so much going on, people can't have avoided seeing what's happening at Kistos. But initially, I'd like you just to give us the rundown of what Kistos is, what you plan for it, and we can come into the detail in a minute.
Sure. Well, look, there was a serious conversation when we set up, after selling out of Rockrose, which was obviously very successful for shareholders. We said, is there a role for another oil and gas company in the sector as a listed company? Not that there isn't money to be made in black oil, but as a listed company, what does that look like? And the conclusion we came to was, yes, there is, so long as you're focused on gas and you're focused on a low carbon agenda. And we're really pleased to have actually secured the transaction with Tulip, which hits both those buttons absolutely bang on. So it's gas production with good free cash flow, very low OPEX per barrel, and also a very low carbon agenda, which we think gives the opportunity, and we'll talk, I'm sure, a little bit more about this in a minute, but gives the opportunity to re-rate the business when people realise that we're going to be zero Scope 1 emissions from the outset.
Yeah, and so let's do the most interesting thing, I think, about it all, man, which is this, the emissions and the low carbon and so on. Because, first of all, historically, the market has been its guide level has been Johan Sverdrup and what Lundin have been doing and so on. And so talk us through, yes, it's gas. We know that it's unmanned, no helicopter deck or anything like that. So it's quite a big change for people. So talk us through it.
Yeah, so you're right talking about Johan Sverdrup. So Johan Sverdrup is oil as well, operated by Equinor. That comes in at around 200 grams per BOE produced. The average UK CS gas field, UK continental shelf gas field, is around 23 kilos per BOE, per barrel of oil equivalent, in terms of the carbon that's emitted. And our assets are around 13 grams historically over the last 2 years. So, de minimis levels, which is very easy to offset. Yeah. And so we're going to be in a place where we're going to be zero Scope 1 emissions from day one. But let's not forget, it's not just about the emissions position, it's about the cash flow position as well. And these assets have a really, really low OPEX per barrel, around $5, $5.50 per barrel of oil equivalent.
That's crazy low, that is. For
it's very low. And, people like Serica, for instance, who are, justifiably very proud of $15 a barrel in terms of their cash flow per barrel. Their OPEX per barrel. We're making $9 a barrel more for every barrel we produce. So the advantage of these platforms is they've been designed and installed recently, and that gives you a lot of gains in terms of technology, in terms of the unmanned position, and that's what takes your carbon footprint down, but it also takes your absolute cost down. There's no compression on the platform. The gas is shipped and compressed at shore. At the moment, it's compressed on a third-party platform, but will be compressed at shore and then injected into the network. Normally unmanned, as you said, no heli decks, accessed by boat, generally visited once every 2 or 3 weeks, powered by solar on the south side, and wind turbines, which have recently been upgraded on the weather side. So there is a gen set on there, a diesel generator on board, in case it's needed, but it just very, very rarely gets used.
And you get started up when the guy comes in to service it. Probably.
And typically it's when people are on the platform that it's used.
Yeah. So as before, you started off with production, and it was never meant to be anything other than a production company as before. But you have got upside from potential exploration, and although the production is gas, I noticed in your recent presentation that you have got some oil in the process. So first of all, what's the upside in terms of exploration, or because I know you've got other areas in the license. And the second part of the question is, I've seen the oil which sits above the gas. What happens to that? Because of course, if you start producing oil, you change the process a little bit.
So using the term exploration, actually, most of what we've got is discoveries.
Right.
So these are things that were already discovered. So we've got Q10A, which is the producing asset right now.
Yep.
We have Q11B, which we're drilling an appraisal well in later this year, which is basically a mirror of Q10A, and again is a discovery. Then there's Q10B, which is sorry about all these numbers and letters. This is the way the Dutch do it, rather than if it's sort of names of gulls and things like in the UK sector, it's easier to remember. But we've then got Q10B, which is a subsea tieback back to Q10A. So again, all discoveries.
So these got discoveries, and you'll be drilling just development wells, not even appraisal wells.
Well, I mean, we're drilling an appraisal well on Q11B later this year, but it's already discovered, and that will become. We want to access the up-dip volumes. That will become a production well, so it'll just be suspended, and then once we've got the results from that, will become part of the production well.
Yeah.
We also, as you rightly say, have got the Veland oil potential. We know that the oil is there. It's been drilled through a number of times when they were drilling the other Q10A wells, so we know that the volumes are in place. We just need to flow it to ensure that we put the right structure in place to access all that oil going forwards. So put the right technology in place, depending on how tight it ends up being, etc.
Yeah.
You're right. It's not really, oil is not the bailiwick of Kistos. It's not what we're set out to do. But given that it's immediately above our existing assets, we think it's best that we at least develop it in the first instance. If we subsequently sell it down, then we'll look at that. But it will be developed, much like Johan Sverdrup, with a shore-powered solution, and again, a very low-carbon solution. And you rightly pointed to Lundin's comments. Lundin's looking to be zero Scope 1 emissions by 2025. That's a stated ambition. It's been referenced in various things, like there's a piece of Jeffrey's research recently that talked about that. And they 2 days ago came out and said, they've got their first oil which has been certified as being zero Scope 1. We're going to have that with all of our developments from May of this year, not 2025.
Yeah.
So that's a very strong position, I think, and I think that that combined with the strength of the cash flows coming off the assets gives a lot of opportunity for both shareholders and bondholders to see an increasing scarcity in alternative investments that people can go into, like ours, like into Kistos, with a low carbon footprint.
Excellent. Thank you for that. I'd like to go through the financing of the process, because, as usual, it's been interesting and highly oversubscribed. So, you raised 52.5 million, which was way above the sort of the top end of the range initially. That I was expecting something above 40 at 155p, and you did that through various different platforms. In particular, you dedicated a fair bit of it to primary bid, so that the retail could come on board. You had placing and subscription, in which you brought in some very substantial blue chip institutions and the board have put in even more money themselves. So perhaps
Yeah,
you could run
so
through
the board, myself included, put in over £1.5 million into the placing. I put another £1 million in myself. We thought it was really important to, and we committed at the outset of Kistos to involve retail in the best platform we could. We decided that the best way to do that was a primary bid offering. Some people, one of the downsides of the primary bid thing is you can't. No one from outside of the UK can subscribe, and so I got a lot of complaint emails about that. But there's frankly nothing I could do about that.
Yeah.
It has to be people from inside the UK. So we did that, and we've got a really strong institutional base. So, we welcomed the likes of Schroders, Fidelity, Canaccord Genuity, Chelverton into the mix now, and so we have a really strong institutional base, as well as a significant amount of the equity owned by the board, including myself. So, we're doing this. We're running this business for shareholders. We're not running this business for our salaries, frankly.
No, and we'll come back to that in a minute, of course, and which is what shareholders like about it. And just before we go on to something else, you've the vendor always said that they were going to raise a bond. That's been announced today by you. What's the form on the bond?
So basically, the total purchase price, as you rightly said, was 222.75 million on an enterprise value basis. We assumed an 87 million euro existing Norwegian bond, but that had a change of control clause in it, which meant that we needed to refinance that, and we've refinanced that today, and we've refinanced that on very good terms, and with our partners ABG and Pareto in Norway. That bond was also significantly oversubscribed, so that's just.
Why don't you put into perspective what the whole thing? I mean, the equity was oversubscribed. Everything was. Talk us through how much money was chasing after the available money for this. Sorry, I put you on the spot there.
I've got to be slightly careful how I answer that. But,
in rough
the
terms,
bond was significantly oversubscribed, and we raised 90 million euro, so about 80 million pounds. The equity was significantly oversubscribed. We raised 52.5 million pounds. We previously raised 36 million pounds. So overall, we've raised over €250 million over the last 5 months to fund this company, and committed a lot of our own money to it as well along the way, and that's been oversubscribed. So I think people are enthusiastic about the vision that we've got here. People are enthusiastic about something that produces significant cash flow, but also has something you can be proud of as well. That my 12-year-old youngest child is now very conscious of environmental matters, and to be able to say, look, Daddy, you're not running a dirty oil business anymore, but actually you're running the cleanest gas extraction business, and gas is really important in energy transition in the North Sea, and probably one of the cleanest in the world, is something to be proud of. And so, but we still need to, generate cash, and we're expecting to make in excess of €50 million of EBITDA this year. At current gas prices, if anyone looks through the admission document, you'll see there's a CPR in there. All of the MPVs that are in that CPR are at 15 and 15.3 euros a megawatt hour. That's the way the Dutch measure the gas price. The current gas price is 21.5 euros a megawatt hour. So that's significantly more free cash flow coming off these assets. And remember, we've owned it on an economic basis from 1/1/21. So that's going to mean there's going to be significantly more cash in the company at the time we complete the fundraising, complete the transaction.
Yeah, which should be imminent. I mean,
yes, immediately after the EGM. So we have to have, under AIM rules, you have to have an EGM for a reverse takeover. Given the nature of the register, there's not going to be any issue with that. and then all of the new shares, the 52.5 million that's been raised, will be available for trading. I think it's around the 20th of May, once that meeting's taken place.
Good. I'd be interested in your views on what the M&A situation in the oil market looks like at the moment. Anyway, I mean, I can't imagine.
I'm not in the oil market. I'm only in the gas market.
Yeah. In the energy market, transition market, whatever you like to call it, it's good. And in particular, because I can't imagine there's anyone who's more hands-on at the moment. And in particular, I imagine you've looked at more than just Tulip. Tulip was the first cab off the rack, so to speak. But it became available, and you did the deal. So tell us what you think about the market is like. You know, who's running for the hills, who's with you looking to buy in, and you know, the obvious question is, you know, have you got more lined up for the keen shareholders to look out for?
I think, you know, people who've known me for a period of time will know that I don't tend to let the grass grow under my feet for too long in terms of doing transactions. The Tulip deal really did hit the sweet spot. There are other gas deals to be done out there. One of the complications, frankly, is there are very few deals that you can do that are as strong on the carbon and both on the cash flow as Tulip. I mean, you know, when you're producing gas at, you know, $5 a barrel, you know, the free cash flows off that are significant, and you know, that's very different to you know, just to highly manned older platforms. But there are still things to be done out there. There's a lot of stuff around repurposing assets at the moment, which we see significant opportunities in. We see opportunities in gas storage and energy storage, which can add to the portfolio and be a good adjunct to where we stand. So there are things that are unloved and need a change in ownership, and you know, that's what we do. That's what that suits us.
Yeah.
So we do see some significant opportunities, while others might look at it and say, well, you know, to repurpose this, we're coming at it from a green side. It's quite complicated. We've got the history of understanding how to run legacy assets, and as a management team, we're good at that, and we've got a demonstrated track record of doing that, and we'll continue to do that kind of thing.
Yeah, and it's interesting because it has to be said that when you started with Rock Rose, the market didn't initially buy into it, but as soon as you started to deliver a number of deals, the market twigged very quickly, and the shares went up a long way. If it hadn't been for this time last year, you know, it might have been even higher, because they had been even higher. With Kistos, there is a lot of expectation already. You know, you've hit the ground running from a previous very strong position. The obvious question is, you know, what's the longer term plan for Kistos? Is it what's the exit route? Is it trade sale? Is it a long way down the road yet?
I'll answer that the same way as I answered it with Rock Rose. To be honest, is I for what it's worth, I don't think anyone should run a business on the basis of what the exit is. You should run a business because it's the right thing for shareholders. Yeah, and each decision you take each day is the right thing to do for shareholders. Now, as a management team, because we are very significant shareholders ourselves, me in particular, that's my focus. And if you keep doing that, you're going to create value, which is going to mean that you are generating value for shareholders. You're going to pay back dividends where it's appropriate. You're going to restructure the capital, as we did previously in Rock Rose, to pay a special dividend where there was money in the company that we couldn't deploy at that point. And so if we can't deploy it effectively, we'll return it to shareholders.
Right. So
but if you're doing that right, at some point someone will come over the hill and say, do you know what, that's a business I want to have.
I mean, in a sense, that's exactly just the second part of the question, because, you know, in some cases with Rose, you ran into a position where you couldn't do various things because you personally got up to 30% of the company. You were buying back shares, which people liked, and paying dividends, which set up. You haven't got a policy, but you sort of already just said that the plan is if there's plenty of money in the company,
we'll be paying dividends. I mean, it's a stated aim. At the moment, under the bond covenants, we can't pay dividends until we've got first gas out of Q11B. So we need to go through that capex, and we wouldn't pay anyway because we've got 100 million of euros of capex over the next 2 years to get Q11B running, to get the new export route directly to shore, to reduce our reliance on third-party infrastructure. So we've got to get those things done, but then we will start distributing cash, and the business throws off significant amounts of cash, and so that's what we'll do. And it's not we're just going to sit and hoard it. And I think our track record in the past demonstrates that that's our approach.
So we've talked a lot, and we're coming to the end of the time. And I always say to my guests, where would you like to see your company in 12 to 18 months' time? To a certain extent, you've answered that in every single way. But I'll leave it with you to say, where do you think you would like to see Kistos in 18 months' time?
Well, we've got final investment decision to take against Veland Oil, against Q11B, Q10A, and getting all those projects online will significantly increase production, push us up to 18,000 barrels a day net to us. Off the 6,000 we're producing now, we're making 50 plus million euro of EBITDA. So we'll get that stuff online within the next 18 months, 2 years. And then at the end of that process, once that's all online, we'll be here announcing dividends that we can pay to our shareholders, and everyone can start reaping the benefits of having believed in the strategy of Kistos from the outset.
Thank you very much for joining me
Thank you,
again
Malcy.
today.
Always a pleasure.
Thank you very much indeed for watching. This has been Malcolm Graham Wood in the first of a new series of CEO interviews with Core Finance. My guest today has been Andrew Austin, Chairman of Kistos plc. It's great to see him and the way that Kistos is developing so fast. I'm sure we'll be seeing plenty of him again. Thank you very much for watching. Goodbye.